What's up, guys? Today we're going to talk about SPACs, or special purpose acquisition companies, the new hot thing in Silicon Valley and New York City. So how do SPACs work, or what are SPACs? SPACs are basically a blank check company. They go IPO, so they basically get a sponsor like Shamat or Bill Ackman, as you guys probably heard of these guys, and they IPO with the idea of acquiring a private company, usually a unicorn or a more mature company. So the sponsor, which is usually an operator or an investor that has a brand name, raises money through an IPO. The IPO process is usually light because there's not much to show except the fact that the operator will use that money to buy a private company. After the IPO, the money that was raised through the process is put in a trust, in cash, or even short-term securities. Then the SPAC has around 18 to 24 months to find an acquisition target, and if it doesn't find the acquisition target, the money is returned to investors. SPACs are not a new thing. They have existed since the 90s and were really hot before the financial crisis of 2008, and they've been picking up steam due to low interest rates, the bull market, and so much cash in the market. A few examples of companies that did SPACs are DraftKings, the online betting platform, Virgin Galactic, the company that wants to take people to outer space, and Nikola, the company that's gonna try to compete with Tesla. And their stock has performed pretty well since their IPO, but we'll see in the future. People kind of make fun of SPACs because it's such an easy way for companies to go public, and they're comparing to ICOs, this craze that happened in the crypto world. A few investors like Bill Ackman raised a lot of money to take companies public. Bill Ackman, for example, raised $4 billion to bring a unicorn public. The sponsors that are bringing the private company public, they receive a 20% incentive of the deal. So if the company ends up raising $500 million, they get 20% of that. That's $100 million. For the private companies that want to go public, that's a much easier process. They don't need to go through the IPO roadshow and all the process that's involved in the IPO. They basically meet a bunch of sponsors, and the sponsors that offer the best deal to them will be the one that acquires them and then brings them public through a process called de-SPAC. In the negotiation time, both the sponsor and the company they negotiate terms about valuation, governance, if the money raised is primary or secondary, if it's going to go to the company or to existing shareholders. Also, there's a new process called PIPE, where the company raises money just after they go public. And that's exactly what Desktop Metal is going to do. They're going to raise even more money right after they go public. The IPO process has been broken, and Bill Gurley, a big proponent of the idea of moving away from IPO to, for example, direct listings, showed that investment banks that are underwriting the IPO process usually underprice the stock price of the company going public by around 32%, and they even take a 7% commission. That means that companies leave around 39% of the deal on the table to investment banks. The reason why investment banks underprice the stock that's going IPO is because the bank that's underwriting will sell the stock to their clients, so the clients get a deal before the company go IPO. So they will pay whatever $17 for the stocks when the company goes public, and after it goes public, these clients can sell for a profit. The IPO process is extremely broken in that way. Investment banks, for example, tell their clients that the price is right when it's 30 times oversubscribed, and 97% of the clients that hear the deal accepted. So that means that if they offer the stock for a certain price, that means that whenever the company offers the stock for a certain price, 97% of the clients need to convert and say, yes, I would buy this deal. In a normal market, you wouldn't expect that, right? You wouldn't expect everyone to want the deal, else the deal is too good to be true, right? That means that they're underpriced. There's a new process called direct listing, where companies don't do the bake-off or offer the stocks to the clients. Basically, the stock goes directly to the market, the way the stock market opens every day. Through direct listing, the price is determined by the market instead of clients trying to guess the price of the stock. It's basically a real market. The difference between direct listing and IPO is that in direct listing, companies couldn't raise money so that they could keep the company growing, but this rule has changed yesterday, and now companies can raise money through direct listing. So summarizing the whole IPO process, there are the SPACs where sponsors buy up the company and take their public, the IPO, that's the traditional IPO process, and direct listing. I hope you guys liked this video. If you liked, subscribe to my channel, leave a thumbs up, or leave any comments if you have any questions. Thank you. Have a good day.